Day traders are always told that they need to backtest their strategy before deploying it in the live markets. I'm here to tell you, you don't need to backtest at all. You need to forward test. So, when I was at a conference in 2023, I was told about a very interesting concept. Hedge funds say that you need 20,000 backtested trades to be within 2% accurate of your backtested results. So, what does that mean? If you have anything under 20,000 trades logged in a backtest, your results are not going to be accurate. If you have only 50 trades or 100 trades in your backtest, your results are going to be 17% off. So the final P&L is going to be expected 17% difference. That's insane. It's huge. It's not possible. So what I'm saying is, if you are going to backtest, you need to be 100% algorithmic, because an algorithm can backtest 20,000 trades. They can totally do that, and they can have a backtested system. However, if there's even 1% of human decision in your strategy, you're not 100% algorithmic based, and therefore that backtest that you did is null, and you're probably not discretionary backtesting 20,000 trades, especially on replay mode in TradingView like I used to do. So yeah, you just have too small of a sample size. There's no way to discretionary hand plot 20,000 trades. And that's to be within a 2%, range of what your back tested results are and the results that you potentially could get in the live market. Next, real life market conditions are not the same as replay mode. I know so many people that spend time on currency pairs or, indices, going and back testing, making spreadsheets. I used to do it myself. I have all sorts of spreadsheets with, 100 trades. And the thing is, the replay mode is not simulating live market conditions. So even if you do just get, good market experience, you're still not fully getting the an accurate representation of what your emotions are going to be like in the trade. And last, backtesting does not take into account Black Swan events. If you don't know what a Black Swan event, that is just a random event. For example, when the Taiwan War happened and the market tanked like 4 or 5%, or when last year in August when we had the Japanese yen swing trade, things, or the California wildfires or COVID, these things you can't backtest. They're Black Swan events, and they're going to affect your trading system. And if you're discretionary, you can avoid those types of mistakes. If you're systematic, you can't. So what to do instead of backtesting? I do something called forward testing, and all that is going into the chart every day and taking markups. A markup is, so I have the 15-minute chart on the left side and the 1-minute chart on the right side. A markup is just using this tool. You can go into the forecasting and measurement tools, grab the long or short position, and when you see an entry signal, you take the profit, the stop will go for 1R, and you forward test it. You watch it play out in live market. You can take it on a sim account, you can take it on a demo account, whatever you want to use, and you're going to test it. You're going to see how it performed. And then what you're going to do is you're going to go save the markups, and then you can go into your trades, and you can go into the playbooks. So you go all the playbooks you have here. Now, for your system, you're going to create different entry signals and entry criteria, and then you can back test it all, or forward test it in this case, and put all of the information in here. Spend 2-3 months doing this, get a sample size. Now, after a couple months, you're not going to have 20,000 trades, but you're going to have some pattern recognition. You're going to have a small sample size, and you're going to know what at least you can start to do that's going to work with you. I think this is a better way to, air quote, backtest a strategy, because at least you're going with the live market conditions. Now, let me know your take on this. Do you agree? Do you disagree? What would you do?